Good morning, everyone. Thank you for joining this morning's webinar on the future European DLT-based financial market architecture. Certainly a mouthful, but we'll kind of start to unpack the different aspects of this in the course of the next hour. I just wanted to mention that this is the first of a series of Optic webinars that we are hosting here at AFME. Optic is our annual flagship conference on post-trade, digital innovation and operations. This year, it will be returning to London on the 19th and 20th of October. So do feel free to register and attend, and we hope to see you there. I am Coco Chen, an Associate Director in AFME's Technology and Operations Division, leading on DLT and digital asset adoption, really working with our membership to promote their interests across these areas, but also facilitating public-private collaboration across digital innovation topics. Today, the focus of our webinar is a new report that we published on the future European DLT-based capital market architecture. This is the result of very extensive research and also interviews and conversations with our membership, and also, of course, very much responding to the parallel policy initiatives, both from the Euro system as well as from the Bank of England, looking at the medium to long-term capital market architecture, in particular, moving these markets on chain over the next period of time. We'll begin with a quick introduction on policy and market developments underpinning this topic, and then kind of move on to an interactive conversation with the panelists on the different themes, as well as prerequisites and actions that are needed to really kind of move our wholesale markets on chain, and conclude with 15 minutes of Q&As at the end. Attendees are very much welcome to submit your questions throughout the course of our conversation, and we'll jump into the Q&A when the time comes. So really, really delighted to be joined this morning by a very expert panel. Great to have all of you here, both AFME members, but also Richard from the Bank of England as well. Hopefully you can see the slides here. So across the panel, we have Richard Lewis, who's a senior manager at the Bank of England, Thomas Brophy, leading on digital assets and currencies transformation at Deutsche Bank, Mauro Pernigo, who's a business director in Intesa Sanpaolo, also leading on digital assets and DLT, Martin Onyeder, leading on digital asset and digital capital markets at NatWest Markets, and myself, of course. So thank you for joining us this morning. Certainly a lot of expertise to draw on. First of all, just in terms of the vision that we've set out in the report, as I mentioned already, this responds to the ECB's Project Appia, which is very much looking at the medium to long-term financial market architecture, also taking into account the availability of a DLT-based central bank cash solution. And it also responds to the parallel work that the Bank of England has been working on in terms of synchronizing its real-time gross settlement system with DLT ledgers. Both of these initiatives are very much in train, and I understand on track for delivery in the near term. I think it all really kind of stems from clear acknowledgement from the public sector that DLT will play a key role in the future of capital markets and financial services. And this is because it really brings unprecedented opportunities for greater efficiency, for programmability and precision in terms of transactions and settlement, for more direct access by issuers and investors, and ultimately the ability to lower costs and for transactions, but also the ability, crucially, to link markets and actors through a common layer or a network of networks. And this is really the kind of key innovation here. I think it's now a question of not if, but when. And of course, we know that European policymakers and also market participants alike have been preparing for these markets of the future. But that said, it's not a small feat to transform some of the deepest and largest markets in the world, and they're piping. And this is an effort which requires a lot of collective action and support from all sorts of ecosystem partners and participants, ranging from policymakers and authorities, but also including financial institutions, investors, issuers, and real economy actors. So in the last 6 months or so, we've asked our members a very difficult question of what this end state financial architecture might look like. Broadly speaking, there are kind of three models that kind of came out on top. And those include first, a unified ledger encompassing both assets and cash. Secondly, a multi-chain network model. And third, a public permissionless network. The answer we received from across the AFME membership is that the most operationally viable, secure, and commercially attractive way to move forward is a multi-chain DLT network consisting of asset ledgers operated by regulated financial institutions with interoperability enabling cross-ledger connectivity, and also operating on a public permission setup would allow for broadened but regulated access. We also see a role for public sector ledgers for DLT-based cash, so in the form of central bank money, but also this can help in terms of connecting those different market-run ledgers. We'll unpack the rationale behind this vision shortly with input from the panelists on the line, but largely kind of speaking, this vision really kind of it came out on top in terms of optimizing the ability to generate network effects, the ability to achieve settlement atomicity and programmability, taking into account regulatory considerations, maximizing resilience and throughput, and also really delivering on the innovative potential of this technology. There are kind of broadly speaking 6 recommendations that we landed on as being crucial to deliver on this vision. Those are, first of all, asset interoperability. In a multi-chain world, this is absolutely critical for transferring and exchanging assets between different ledgers, whilst maintaining their data and programmability functions. And that's why the development of asset interoperability standards based on public-private collaboration is extremely important. And going forward, the legal and policy framework should recognize DLT's ability to transfer assets, control assets, but also achieve operational settlement finality. Secondly, cash. The availability of DLT-based central bank cash is also critical for really allowing for the settlement of DLT-based assets, as well as for monetary policy transmission and also maintaining a two-tier banking system going forward. We're very supportive of the Eurosystem and Bank of England's initiatives in this area to make available an interoperability central bank cash solution as soon as possible. And both sides appear to be on track, and Richard can speak to that in a little bit. And this is also very important alongside encouraging innovation on commercial bank money solutions like tokenized deposits, deposit tokens, and stablecoins, which help to play a complementary role to central bank money and might be more suitable for some markets and users. Third, we think that as part of the vision for cash, private public cash ledgers really provide a way forward to accommodate all the different cash solutions that I spoke about on a cross-currency and cross-jurisdictional basis. These can also, as I mentioned earlier, help connect the different market-run asset ledgers. Fourth, our members have expressed some caution when it comes to unified asset and cash ledgers. And this is because whilst there are some benefits for integration and atomicity, this model can unfortunately undermine existing investments and pose limitations in terms of flexibility innovation and also connectivity with different asset classes and different international markets as well. Fifth, collateral eligibility, an absolute prerequisite for issuers and investors. That being said, collateral mobilization is, of course, one of the key benefits of DLT in allowing for more precise and programmable settlement and faster movement of assets. We've issued a number of recommendations for really allowing for collateral eligibility for DLT-based assets. And those kind of cover legal recommendations, but also operational considerations in terms of recognizing asset controls and movement by regulated DLT platforms, and also integrating these platforms into the existing collateral mobilization architecture. And then last but not least, complementary regulatory reforms really play a key role in supporting this framework. And there are very much kind of live and policy initiatives and reforms that are being introduced under the EU market integration and supervision package to improve the DLT pilot regime, but also, of course, the UK digital security sandbox. Those are all initiatives that are in motion already. And from our side, we're very supportive of bringing them to completion and to commercial scalability. So a very long introduction. I will just kind of exit out of the slides now, but of course, very happy to take any questions on recommendations as part of the Q&As. But first, I just really wanted to turn to the market participants on the line, Mauro, Thomas, and Martin in particular, to ask you why we've set out this vision. Why is a multi-chain DLT network the most viable way forward? And why perhaps not a unified ledger encompassing both assets and cash is the preferred next step from a market perspective? Mauro, maybe turning to you first.
Okay, thank you, Coco. First of all, I just give an information. I am a business director in Intesa Sanpaolo, but at the same time, I'm also in the board of director of SWIFT. So just to be clear, for any possible conflict of interest, I will say beautiful things about SWIFT, and so you know why. I think that we are in a moment which is, I have to use this term, historical for the financial markets, because we have a bunch of changes that will improve the next century market. I'm pretty sure of this. We know that the central bank, in particular in Europe, is working on very important projects to have a digital euro for citizen enterprises, and so the financial market will benefit of it. The most important are, of course, the wholesale digital euro, which are in the form of Pontes, which is the first experiment, the first pilot starting this year, and will ultimately go to an Appia solution where the dedicated DLT will be set for the market. In this DLT, we will have the central bank money, but possibly we will have also forms of tokenized commercial bank money. Now, this might really drive to a complete new market. Try to imagine that you have an exchange of money, a clearing of money on which you can put all your normal SEPA payments together with the target to payments, together with the commercial bank, the correspondent bank transactions, and so forth. And this might create a very strong efficiency for the treasury of intermediaries. We know that ECB must be absolutely independent in their choices, so we must expect that they will have a kind of close garden in which they will drive their assets. They cannot depend completely on third parties for reasons which are, I think, obvious. So we must expect that they will have a very strict control on the DLT that they will use for their money. Nonetheless, it's very important that this will not prevent the private market to interact with also other solutions in order to minimize any form of, let's say, cash island here and there, which might be not effective for the market. Interoperability must be one of the great word to avoid any fragmentation of liquidity. And this is, I think, one of the most important things. So ECB, who will work with their own needs, in terms of the product market which will cooperate, they must be interoperable. The ECB platform must be open to accept also intermediaries' writings when this is the need. So some of the commercial bank money, once digitized, might be it might be written on the same DLT, but also with third-party solution, there must be a very effective interoperability. This is fundamental for the market.
Thanks, Mara. I think you've just spoken to the importance of ensuring that a central bank cash ledger is able to interface with privately run asset ledgers, and also to achieve interoperability in a multi-chain world. Thomas and Martin, I was wondering if you could kind of bring in some examples that your institutions have been working on in terms of really kind of paving the path towards this multi-chain new world, if we may call it that, and how you kind of see the different industry initiatives, but also public-private initiatives as being facilitative of this future.
Cool. So maybe I can start and maybe just from my perspective as well, just taking a step back first, because I think it's worth touching on why a single chain is maybe less optimal. Because I think ultimately a single system sounds simpler in theory, but markets today aren't governed by a single authority. We've got kind of multiple global participants who are then regulated and supervised at a national multi-chain public permission model making more sense because it reflects the reality ultimately of what we have today. You can have the different networks emerge around particular asset classes or regions, but still within a regulated framework. And it also gives better balance. I think this will start touching on your question, Coco, but we can keep the control and governance that's needed in financial markets, but it doesn't stop or slow innovation or competition by forcing everything onto one single system. And in terms of scaling this commercially, Mauro touched on it already, but a few things really matter. It's around the settlement assets working across different networks. Otherwise, we end up with fragmented liquidity. And there are a number of kind of industry, public-private initiatives ongoing at the moment in those areas with many banks part of kind of different parts of the puzzle. There's a second piece around common standards. So these platforms can actually connect to one another. And Mauro, you mentioned this too, but we need to be able to connect to these different infrastructures without rebuilding each time. And I think the final point I'll make on this is around legal certainty. So things like settlement finality, ownership, and ensuring that the different tokenized assets that we're creating can plug into some of the existing frameworks, like those that exist for collateral today or for risk.
Thanks, Thomas. That's very clear. And Martin, just turning to you in terms of maybe some use cases if you're able to provide them.
Yeah, absolutely. And thank you for the invite. So look, I guess I'll also want to take a step back as well. If we just look at, what the future holds for us, we need to be cautious that we're not, essentially creating like the term faster horse, right? And I think Sarah Bruna mentioned about the part with Ferrari with what the work in the Bank of England doing, right? So there's a lot of potential right now, but we also need to be cognizant that a lot of the existing rules and the way the market is structured, the architecture, isn't necessarily going to be optimal for the future. And so I think there's a definite, strong push with this, to just reimagine a lot of the processes we're doing now. I think that will probably come across a lot of the discussion we come talk a bit later, but just in terms of actually the use cases, look, I think if we are thinking about the multi sort of ledger verse, I think ultimately going to be the case, right? You're seeing what's happened in the stablecoin space. I think I don't know how many hundreds of different ones they are, and there's still ones coming up every single day, new announcement. Um, you're also probably going to see the same on the asset side of things too, right? And I think it's important that in terms of there's not to stifle that innovation, because essentially it's not necessarily about the best chain wins, and now everyone will move to iOS versus Google. It'll be that ultimately that app works on your iOS or Google, right? And that's the main thing. The interoperability has to be um, intrinsically implemented throughout how we sort of build this infrastructure from this moment in time. Um, and the likes of the ECB via Appia, we would hope that that'll be along the framework it deems to create, as opposed to having looking to create a sort of a unified ledger of some sort. Um, in terms of what you're seeing out there in the market, I'm sure people are familiar with the likes of the Canton network, and I go more closer to home, might be in Europe for me, being our one of regulated layer one, which is a really strong example of a market-led initiative, being a European cooperative to be that shared sort of network settlement layer, essentially, which should be aligned with what AFME's and ECB's approach of, look, just make sure the plumbing's all everything can fit in, and let's compete on services in the future. And so I think that's the narrative we want to sort of put in place. But I think again, right now is very important. We do, with the other sort of networks out there, because there are a number of different initiatives across the globe, that we all are still aligned in terms of, okay, that's how do we, as a number of us, our banks here, compete? Let's not focus on the settlement layer because it really is irrelevant. And we do hope the likes of ECB and other regulators across the world, because ultimately we are on a global market here, and there has to be when we talk about interoperability, I don't know whether we're going to go to as far as ISO standards, but there would have to be certain levels of I think the bits which AFME recommend about on the asset token and protocol layer, at what stage do we have to have global standards for all of them, for us to for the market to scale.
Absolutely. And we'll come on to what's needed for asset interoperability shortly. And I think you have already kind of mentioned a number of kind of keywords in this area. I think plumbing, obviously, and reimagining the structure, but also kind of allowing for innovation. I think just kind of looking at what the UK is doing, and Richard, I think you have been instrumental in a lot of the reimagination of what the financial system might look like going forward. We know that a number of key documents just came out from the UK authorities this week, and very curious to see how you think the UK's vision might interact and accommodate some of what the industry is building, which it sounds like is a kind of natural evolution of the current market in some ways.
Yeah, sure, absolutely. Yeah, I mean, thanks for highlighting. We published a number of documents on Monday. Probably the most relevant for this conversation is our joint vision with the FCA for tokenization in wholesale markets. Is essentially setting out our kind of joint authorities vision. I think there's a good degree of commonality between what we've set out there and what you've described and what other panelists have kind of talked about in terms of your vision and recommendations. I mean, just in terms of a broader view, kind of if you want to look across the full range of what the bank's doing, to modernise money and markets, I would recommend taking a look at Sarah Breeden's speech, which was published on Tuesday. I mean, that's where the part Ferrari analogy that Martin mentioned came from. But yeah, that's one she's particularly keen on. I've heard that a number of times internally. But in terms of the vision paper, I think we had said a few new things, as well as kind of trying to highlight a number of initiatives that we already had in train. I mean, in terms of where we want to get to, as I say, we set out that vision for a digitally enabled wholesale market ecosystem, and that's got a few parts to it, including first of all, kind of more efficient movement of tokenized assets and money across the trade life cycle. Kind of enabling kind of all the improvements and use cases that we're kind of well aware of, in an ecosystem that is safe and resilient, and anchored in central bank money settlement. We think interoperability between tokenized and non-tokenized infrastructure is going to be really important going forward, particularly kind of during any transition phase. And, it is conceivable there is a world in which, certain kind of asset markets remain on non-tokenized infrastructure. That could well be the right outcome for for certain parts of the market. Very keen on private sector innovation based on sort of trusted public sector foundations, so that we can provide high resilience, good quality regulation to ensure markets remain clean. And I think probably the other part of the vision I'd bring out for this audience is that, we do believe tokenization is able to support deeper and more liquid capital markets, support the real economy through more effective credit creation, and improve efficiency and effectiveness of kind of primary issuance of equity and debt. So that's where we want to get to. With this paper, we're trying to kick off a bit of a conversation and the process for developing a longer term strategic roadmap. And the other kind of part of the puzzle to talk about is that this obviously builds on HM Treasury's wholesale financial markets digital strategy, which came out last year. And obviously, the kind of recent news on that is the appointment of Chris Willard as the wholesale digital markets champion. And, we're obviously, as you'd expect, working closely with them to make sure we're joined up and, there's commonality between what we're doing. In terms of kind of immediate next steps, there's a few priority areas that we've identified. And there's that includes a set of ambitions. There's some work we're already doing and a number of new commitments. And this is all informed by industry engagement. I think hopefully speaks a bit to kind of what you've kind of found through your own process and kind of developing your report. So there are quite a wide range of areas, and that reflects the range of levers that the bank and the FCA have at our disposal. To draw a few specific ones, where we make new commitments. So in terms of the digital security sandbox, obviously we have 16 firms already taking part in that. We're committing to introducing a comprehensive regulatory regime for issuance and settlement of digital securities, and that includes a clear pathway for firms that are in the DSS to kind of, move into kind of more permanent authorization position. We're very keen to kind of promote equivalent treatment of tokenized and non-tokenized assets where the kind of underlying risk and kind of legal realities are the same. And that includes both kind of prudential treatment and use as collateral in central bank operations and at CCP. So another document that came out on Monday, the Prudential Regulatory Authority issued Dear CEO letters about treatment of these types of assets. Within the paper, we're kind of committing to prioritizing work on being able to accept tokenized collateral in our own operations. Very keen to promote access to new forms of settlement in central bank money. Some of you may be aware that we are already running a synchronisation lab. We have 18 participants in that. So I can talk about that later, maybe a bit later. The big commitment we've made there is that we're going to launch a live service from 2028. I think the other thing that kind of, in terms of kind of enabling that central bank money settlement is that we published on Monday a consultation for taking RTGS and CHAPS settlement hours, so i.e. kind of the core system you need to access to settle in central bank money, our kind of roadmap for moving that towards near 24/7 settlement. And yeah, obviously we're very supportive of what Treasury are doing in terms of issuance of the digital gilt, the digit. So hopefully that gives a bit of sense of how we see the way forward. Particularly kind of that connectivity with private sector solutions in terms of the synchronization interface. Before I stop, I was just going to touch very briefly on kind of what we're doing in terms of international work. That's been a major priority for the bank for several years through the G20 cross-border payments roadmap. But I think the focus on DLT is probably a bit new for us. Just a few things I draw attention to. It's more at the experimental end. So, we concluded work with other central banks, including the ECB, on Project Meridian FX, which showed how the synchronized settlement model could be applied to foreign exchange transactions. We're extending that with Meridian FX APAC, where we're kind of pursuing further work with the Monetary Authority of Singapore and Bank of Thailand. And as you're probably aware, we're participating in Project Agora, which is more at the kind of unified ledger end of things. But, I think we want to maintain an open mind towards towards what the range of solutions could be. That's obviously very much at the kind of grand vision end of things, international piece of infrastructure. But yeah, we're involved in that and kind of informing the direction that goes in. I've talked for quite a bit there, so I'll stop there. But hopefully this gives a bit of a sense of kind of the direction we're going in and kind of how we see the future looking.
Absolutely. And I think from our side, we're very appreciative of all the different policy work that's been kind of going on, and particularly to really kind of foster this tech neutral approach to DLT assets, but also in terms of really recognizing the potential of this technology and also kind of making available a DLT-based central bank money solution as soon as practicable. Just wanted to kind of maybe pick up on a few things you say and also kind of turning to the others, maybe first on cash, and then we'll go back to the I word, interoperability. I think there's a kind of real question around how, and you mentioned already the different international initiatives on cash, but actually how these ledgers might be able to accommodate both central bank cash and also commercial bank money solutions. Just wondering, Richard, if you've given kind of any thought to this, or if there are any kind of lessons from the existing initiatives, both international but also domestic, on how this might work, if you could share with us.
Yeah, absolutely. So, in terms of how ledgers can accommodate both, Agora itself is a key example of that. It's a key consideration. I think also through the synchronization lab, if you look at the some of the solutions that are being explored there, for example, we have GBTD is one of the kind of lab participants that obviously kind of at one level there's kind of tokenized commercial bank money kind of backed by the central bank. I mean, this is where we think the kind of power of the synchronization layer comes in. So essentially, we create something where it's hopefully a relatively, there's technical integration required, of course, but it's not the level of lift that is required for, connecting to a brand new piece of infrastructure that's kind of monolithic and takes, a number of years to build to kind of, national infrastructure standards. It's a kind of much more, it's kind of plug and play type solution. That then enables the benefit of kind of settlement in the ultimate risk-free asset being central bank money, while kind of enabling the scope for kind of innovative new solutions. So you can have that kind of we're not constraining the private sector with the speed that we can move, because obviously we have to, there's a range of considerations that come from kind of public sector infrastructure projects, as people are fully aware, I'm sure. So yeah, the ability to kind of talk and take what's useful from one place. The central bank is probably not the institution that ought to be trying to drive where innovation is going. We shouldn't be trying to pick winners. We shouldn't be trying to determine exactly where the use cases are. We're fundamentally not a commercial organization, but it's that kind of concept of a platform for innovation. You create the guardrails, you create the kind of safe basis upon which others can then take those ideas and see if there's kind of a commercially viable product available. That's the kind of way that we think about it. Obviously, that's not to say that there isn't potential space for kind of something at the kind of more monolithic end of things. And we are doing programs of experimentation where we look at, is there something we're missing by not introducing what's been termed as wholesale central bank digital currency in our own right. And that's obviously the direction that certain jurisdictions have gone in. We think that kind of providing that base layer and then enabling others to kind of innovate on top of that is probably the way to go. But we do remain quite open-minded.
Thank you, Richard. And I think that kind of flexible and agile approach is very much appreciated by the industry. I see Mara and Martin, you were kind of nodding along as Richard was making his intervention, and maybe just kind of wanting to kind of pick up on something you said earlier, Mara, as well, around the importance of the ability of the central bank ledger being able to kind of interact with market-run ledgers. You mentioned some criteria perhaps around or recognizing that there needs to be strict criteria around this, but at the same time kind of needing to maintain openness. Just wondering if there's something, based on what Richard said, you think we can also kind of draw on that for the ECB's playbook, and also in terms of how the EU environment is evolving.
Yes, we see how the EU environment is working, is running, is making trials and experiments. We know that the ECB has a great project ahead, and we will see by 2028 the blueprint of the future solution Appia. So these are the terms which are to some extent quite long. We know that Pythagoras is a project driven by the Bank of France together with Euroclear, where commercial paper will be tokenized and made available for the market. So we see that there are a number of different solutions which are running and are of very high interest. For sure, we must expect that the use of stable coins will be part of the game, will be a way to transfer collateral, at least, if not directly a cash leg. So all of these things must be in the same financial environment and interoperating in the best way. SWIFT made a few years ago, 2 years ago, and last year, a nice experiment called SWIFT Connector. It was called SWIFT CBDC's connector because it was thinking of putting together digital money of different central banks. And it was a nice case of a central interface able to create PVP or DVP transaction, delivery versus payment or payment versus payment among different DLTs, synchronizing common smart contracts. We had also some experiments with a cash on one side of a traditional form on a RTGS with an instant payment, and on the other side a DLT with the security leg. Everything might be working, not always in a very smooth way, not always in the most efficient way. Sometimes you need to have some escrow account in the middle, which may complicate a little the drawing, but the thing is possible. So we see that the market is moving. Pythagoras is a central bank experiment against Euroclear, very concrete. It will be in production in 2028. We see that we are working with the projects like Appia. We need that in something like Appia, we might have all the type of commercial bank money that is, let's say, efficient to have on the same platform of the central bank money. And we need that all the other DLT solution for different segment of the financial market might be interoperable in a very easy way with central bank money. The central bank money will remain, despite any consideration, a security pillar of the mechanism. We cannot imagine that we have a financial market without a strong central bank money in the middle. Otherwise, we will risk to have too many disruptions of other types.
I think that's a very clear vision, and I think just for the audience's benefit, I think with Pythagora, we're also talking about actually very significant volumes and for tokenization, and actually really moving this specific asset class of commercial papers on chain, which will be both very technologically but also symbolically a very critical milestone for European tokenization markets. I know Martin and Thomas, you both have a number of initiatives and asset tokenization examples that you've been working on, which might also kind of help expand this universe of tokenization. And of course, also kind of facilitating and developing in parallel the creation of kind of true cross-protocol and cross-asset class interoperability as well, and cross-institutional interoperability. Is there something you want to kind of say there around, how what the next steps are in terms of what you think are needed, but also in terms of what you think the industry is already building on that is kind of helpful to achieve this multi-ledger universe going forward, and also kind of taking into account, of course, the different settlement assets?
Cool. Maybe I can start and then Martin, hand over to you. But I think to a certain extent we've covered some of the main prerequisites we see from our side. So part of that, and mentioned earlier, is around the settlement asset. So it's the ability to move the asset with the tokens, I guess, to avoid a situation where we're creating some sort of liquidity silos or trapped collateral. So I guess, as Mauro mentioned, it's connectivity to central bank money as the anchor we see as extremely important, and also the different commercial bank money models, but also seeing stable coins as having very much a complementary role as well in all of that. We've also touched on standards quite a lot, and that's across all of the different layers. And Martin mentioned earlier as well, AFME have done a kind of really good job of presenting those different layers, because there's multiple layers. Ultimately, what do we mean? We mean at the asset level for how ownership works, at the token level for how it's represented, and then at the protocol level for how these different systems interact with one another. And maybe just a final point, a big one, I think, for making more progress in this space is absolutely around kind of collateral and liquidity integration. Ultimately, all of this interoperability doesn't really matter economically unless we can plug these assets into the collateral framework. I think that's why the recent moves by the ECB to allow CSD-based DLT securities as collateral is so important. They effectively bring those assets into the core liquidity system. So good initial steps, but I guess more progress needed on that front. And And look, overall, the whole conversation we're having here is very much around DLT improving the existing system. I think there's more, potentially fundamental transformation around things like re-architected markets that is possible in the longer term. But just, I guess it's a level of coordination and change that we're just not at the point of at the moment, which is why we're very much focused on this interoperability topic.
Yeah, Todd, I think that's well said. I think you covered a lot there. One thing I'd like to probably add is more to point towards Richard actually. The what was actually recently published was the DLT Innovation Challenge by the Bank of England, and in there, it's actually what's interesting about the work they've done, which is again I want to commend you on that. Um, I'm here, I'm just give you those props. Essentially, it's a trade-off, right, between you want atomic settlements, and we can use a layer one or layer two. There's security elements related to that. What sort of flexibility in terms of where settlement financing going to be confirmed operationally. It goes in a lot of detail in relation to that. So I guess to a bit back to Thomas, we have to, again, there's that trade-off of what we would like in terms of actually also speed and efficiency, and us again with AFME and the market sort of reach consensus of really which way to go. What's at least we can at least phase it as sort of the sort of these DLT sort of solutions sort of develop.
Yeah, absolutely, Martin. I think that trade-off is really much kind of present across a lot of these different themes and operational transformations that we're grappling with. And I think it's also probably, I don't want to speak for you, Richard, but it's also that trade-off is also kind of being considered in terms of, whether to issue a wholesale central bank digital currency as well in the kind of more traditional definition of that, and what it would mean to distribute that cash solution onto different market ledgers, which is something I know the Euro system is open to. Just before we turn to Q&As, and please a kind request to the audience to please submit any questions you may have for our panelists in the chat. But maybe just a few kind of last questions for the panelists around your kind of wish list for what still needs to happen in order to really bring DLT markets to scale. We've heard a lot about the different policy and market initiatives that are very much in dynamic motion, developing and accelerating in real time as we speak, not least kind of due to the work of the institutions on the line. There probably are kind of still a few things. Tommy already mentioned, standards, collateral and liquidity integration, but also maybe kind of some broader and longer term systemic architectural changes that might be, helpful to start considering. I don't know if Mauro and Richard and Martin, you have anything on your wish list for either for the industry or for policymakers to look at and really prioritize at this stage.
Yes, we have always something to ask to policymaker. The first is to work to define an extended version of the settlement finality regulation, because we must understand when we are talking about DLTs, what settlement finality really means, especially if we are in a context where we have to synchronize or to put together two different DLTs, which might have technical peculiarity, which might be on the same page, maybe not. So we need a big work of that for having a taxonomy which explain us what is the subject behind a transaction, and to ensure that we have a settlement finality which is a proper one. And then on the other side, we need to extend the concept of legal value for contracts or securities or anything once it is digitized and is on a blockchain. We know that we have a lot of the market which still is running on paper, and we need to digitize and to have a cross recognition of the digital value of this possible commercial debt notes or whatever across all the European countries and maybe also with the non-European ones. This is another very important thing, which otherwise will keep the European market formed by different talent running with different speeds. So I need to have a letter of credit recognized in a digital form in any country of Europe and so forth. And this is valid for everything from the checks to anything which goes around the debt and the obligation to pay.
Thanks, Mauro. Indeed, very critical points. Martin, anything from your side in terms of outstanding asks?
We've really touched upon it already, but I would say collateral eligibility as the key point for me for help to build the sort of digital capital markets in Europe and globally. From our experience, that's been looking at the investors who want to participate in a digital bond. I guess that's a lot of my experience has been in that in primary, and they look into it, and that's the one thing they do basically say that, well, if it's not collateral eligible, then we can't play. Look, we with the recent announcement for the CSD DLT securities to be eligible, that's fantastic, and we're very, very, very supportive of that. However, the market has put a lot of investment into, sort of DLT solutions, and a lot of those solutions essentially are being left behind. And we are cognizant that, if there's no, the adoption will stall in digital bonds in particular, if this isn't addressed in the near term. And so that'll be my number one wish list would be, and again, just to look back to AFME and the work you've done in the past. You've done a number of papers on this in particular, where you focus on what risks we should be looking at. And hopefully that could, that goes to regulators, and then hopefully they'll get on board and look to reform the regulations around that.
Yeah, definitely. I think it's incredibly important that the kind of legal and regulatory considerations on collateral eligibility also move side by side with the operationalization of eligibility. And we've set out a number of ways to start to get central banks comfortable with accepting collateral from non-CSD DLT platforms as well, which, as Martin's already highlighted, is incredibly important for investors and issuers. And I know that Richard, in the tokenization vision, that has already very helpfully set out a roadmap towards accepting collateral in central bank operations. You already mentioned that. I think it sounds like it will be kind of taken forward on a phased basis, starting with digit first. Is there kind of like anything you could maybe provide a bit of color around that? Is it and whether the applicants and the participants in the digital security sandbox are already kind of exploring with this aspect of expanding the capabilities of DLT?
Yeah, sure. I mean, just on your kind of the question you addressed to Martin and Mauro, just the one thing I'd say is that obviously what we had in the paper represents kind of what we've heard from industry to date. It's a call for input paper, so really keen to get responses on that, as specific as possible, because then that tells us what we need to do, right? Where industry has a much better understanding of the frictions than we do. So so just a little plug there to try and let us know what you want, and we can try and build that in. In terms of collateral points, we're aware of kind of the importance of kind of eligibility for central bank operations. It raises new challenges because central bank operations, there is a kind of level of risk aversion that comes with that, with the type of institution that we are. And I think probably our traditional way of doing things doesn't always lend itself to kind of sort of new types of emerging asset markets where you might not have, say, the market depth that you kind of do in kind of the assets that we kind of have traditionally accepted. So we have to think about new ways of dealing with that, and whether we've calibrated things in the right way. I'm not a sort of a risk management professional, so I'm trying to speak carefully here, but I think we do want to signal that openness, and there's 100% a chicken and egg problem there, that there's certain amounts of market liquidity you want for your assets, but that market is not going to grow unless the use cases and the benefit of holding it as collateral is enabled by the authority. So there is a step that needs to be taken there, but that's something we do need to kind of work through carefully. So we're very aware of the issue. I don't kind of prejudge where that work comes out, but the message kind of received loud and clear on the importance of this as kind of an area. Just on kind of prioritization of digit, I think we talk about this a bit in the paper. What we would like that to be is kind of an assertion of the kind of UK authority saying, okay, this, we do see this being somewhere where we really want to kind of prioritize effort. This is kind of like a way of kind of demonstrating that commitment. Moving. That's kind of the reason we look to move first with that. But broadly, completely take the point.
Excellent. And, we're very delighted to hear that the points around collateral eligibility are being very well taken into account as part of the rollout of this tokenization vision. And I think just maybe on digit, also very interesting to kind of mention broader AFME work around quantifying the value of DLT markets. We have a biannual market data report tracking DLT issuances from different countries, and that really kind of shows a lot of momentum in these markets, but also showing that actually sovereign and supranational issuers that have explored the use of DLT, including a number of European development banks, but also European countries and soon the UK as well, have really kind of increased the sizes of issuances, but also the sophistication of embedding DLT into their issuances over time. So that's something that we're also very much working with issuers to encourage, and we really kind of see, and our members of course see that as a very integral part of growing these markets. We need the issuances. So I don't know if there are any kind of questions from the audience just in the last minute, or any kind of questions from the panel for other panelists, or anything you like to touch on. Just very happy for you to have the last word. No? Okay, very good. I think that probably means that we've been very clear today. And of course, these recommendations will be taken into account across the EU and the UK in ensuring that Europe continues to take a lead in digital capital markets, hopefully. So we thank you for all your time today, and of course, look forward to working with different public and private sector participants going forward on really kind of creating and making this vision a reality. So thank you so much. Thanks all, and thanks for your time this morning.
Thank you. Thank you.
All right. Thank you. Bye-bye.
Thank you.